India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Well, good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a Friday, finally. We are there, end of the week, finish line, whatever you want to call it. And the last 2 days have looked a little better. So can we actually build on that in some shape or form? That's the hope. I'm Prashant. With me, my colleague Surabhi and Nigel. Guys, hi. Morning.
Hi, morning folks. Happy Friday to both of you and happy Friday to all our viewers as well. You know why the smiles are really wide. But I think there's one thing the week has taught us. I mean, global markets have managed to get over Trump. The executive orders are coming, the announcements are coming, markets have been generally higher. There's some semblance of, peace and, calm. I don't want to jinx it, but across global markets. So I think we're left with dealing with our own issues and our own cues here now.
Well, and I'll tell you what, enjoy the weekend, guys, because next week, we normally talk about a truncated weekend. This one is going
Extended.
to be a 6-day working week, so brace yourselves for it.
First of Feb budget.
Yes.
Right?
Saturday budget.
So
Yes.
It's going to be a lot. Trump goes out and budget comes in that sense. But, well, there's always something, right, for markets to chew on, stew on, whatever you want to call it. But it's looking better. I mean, global markets, etc., have looked settled down. I mean, at a high level, if you think about it, what's played out since the swearing in, since the oath taking, since actually Trump has been in office, is the fact that he's kind of acting more presidential. We've not seen anything rash, big, nothing on day one. So what we were talking about, peak Trump before, and once he's taken office, at least so far, he's been, businesslike, more businesslike than anything. That's not to say that all of this stuff that he said will not come. It's just that so far how it's played out is buy the rumor, actually sell the rumor, and then kind of sort of buy the news. So the reverse. Let's just quickly take it from the top in terms of where we left off things. So U.S. equities higher, 0.5% on the S&P, NASDAQ about 0.25% up. U.S. 10-year yields were up about 3 basis points. We left off at about 4.65. I mean, again, very small changes. Dollar index is there, at about 108.14. Oil was the one which actually sold off, and sold off meaningfully, about 1.5% lower to just under $78 a barrel. So President Trump gave a virtual address at the World Economic Forum in Davos. This was our time yesterday evening. And I just want to put out two things, and we'll play out sound bites, etc. as well. He sounded pretty, at least to me, very sanguine about the US-China relationship. He essentially said things like, we just want the relationship with China to be fair. We don't want it to be phenomenal. We just want it to be fair, nothing more. And we said, well, I already have a pretty good relationship with Chinese President Xi, and we just want a fair relationship. That's it. Actually, he sounded, if anything, much more harsher on countries like Canada, on the European Union, where he kind of sort of went on and on about various things, including how they should pay more for NATO. So that was something which was pretty interesting, and it kind of does you get the feeling that maybe it's not going to be as harsh as he sounded about China during campaigning. It's going to be much more, it's more negotiation rather than putting tariffs and then trying to work out what can happen. Now, the other one which stood out was that he demanded OPEC to actually increase production, lower prices. And these are actually sort of two things he's got kind of direct control on, some amount of influence really on. He also spoke about the Fed and how he wants lower interest rates, but that's kind of his pet peeve all the way in the first term as well. I'm not sure how much that works out. Now, today, just to sort of talk about central banks, you've got the Bank of Japan, which is expected to increase interest rates by 25 basis points. The governor of the Bank of Japan, 10 or 15 days back, actually gave markets that hint, and that kind of sort of priced in pretty well. The only question is for how this feeds into markets is if this hike will feed into a stronger JPY. Because if that is the relationship which works out and the JPY strengthens because there are other variables as well, then you actually start to see a little bit of maybe risk off because of the role of the yen as a carry trade. But I'm not very sure if that will really happen. Now, for the market here, as I said, repair and recovery at the margin a little bit. Broader markets did well, and it's been basically one-way sell-off for the last many days now. Indices, the small and the mid-cap indices were up between 1% and 2%. And we're just sort of taking it step by step. Yesterday, the hourly averages were taken out. Today, we'll see, if there's enough in the tank for the market to take out the swing highs. Maybe not today, but that's the next logical near-term level. 23,426 is that number. And of course, the bank nifty needs to take out the swing high of 49,650. These are nothing but Tuesday's highs, and the market needs to climb back above it. The Nifty Bank actually ended lower. The Nifty did well, and of course, the broader markets did much better as well. GIFT Nifty will give you a sense of how we are likely to start. It's about 48, 50 odd points higher, and of course, there's a slew of earnings reaction, single stocks, which will be in focus as well. Surabhi.
Absolutely. It's a sea of green across Asian markets this morning. And the markets have been doing well. Even the US market indices are up between 2 to 2.5%. If you're looking at the four trading days this week, oil is down almost 4%. That's NYMEX oil that I'm talking about because of everything that Donald Trump has been saying. Actually, before I talk about the rest of the cues, let's play out those sound bites from the World Economic Forum. He made two very important points. One, he's saying that interest rates have to come down, not just in the US, but around the world. And the second, he's saying the price of oil needs to come down. Let's listen into the US president, and then we'll get you more.
Saudi Arabia will be investing at least $600 billion in America, but I'll be asking the Crown Prince, who's a fantastic guy, to round it out to around $1 trillion. I think they'll do that because we've been very good to them. And I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. You got to bring it down, which, frankly, I'm surprised they didn't do before the election. That didn't show a lot of love by them not doing it. I was a little surprised by that. If the price came down, the Russia-Ukraine war would end immediately. Right now, the price is high enough that war will continue. You got to bring down the oil price. You got to end that war. They should have done it long ago. They're very responsible, actually, to a certain extent for what's taking place. Millions of lives are being lost. With oil prices going down, I'll demand that interest rates drop immediately, and likewise, they should be dropping all over the world. Interest rates should follow us. All over, the progress that you're seeing is happening because of our historic victory in a recent presidential election.
So price of oil should come down, and that's how the war is going to end. And interest rates should drop, not just in the US, but all around the world. Everybody should follow the US Fed. Okay, that was the speech from yesterday. Anyway, to talk about the moves over here. Now, despite those comments, it's not like there was a big slide in US yields or the dollar. Those are pretty range bound. Talking about the important events and things to watch over here. One more point from the US. The president yesterday also signed an executive order on cryptocurrency. So watch this space carefully as well. He's pro-crypto. Yesterday, there was an order signed for the development and regulation. It was more regulatory policies and how to sort of streamline the market rather than anything very specific. He did say that the US wants to set up a national digital crypto stockpile. So, let's see what comes out over there. The cryptocurrencies were range bound, not too many wild moves after those announcements because they're on expected lines. Let's come to Asia. We've got a couple of updates over here. First is Singapore has moved to ease policy in some way. They don't cut rates. What they do is, currency intervention, and they have lowered the trading band of the Singapore dollar this morning. That's the Monetary Authority of Singapore. And of course, the big one is going to be the Bank of Japan. Even today, the inflation numbers that are coming out are fairly elevated out of Japan because we've got the core inflation number, and at 3%, that's the highest we've seen in almost a year and a half. So the wide expectation is that the BOJ is going to cut rates it's going to hike rates by 25 basis points, so watch for this. Now coming back to the cues here, again for us it's been a very, very range-bound week. At the headline level, the Nifty hasn't moved much, 0.5% up and down around the flat line. That's what the week has been so far. But the lows were tested and then there was a recovery from there. So last week's low was 23,046. This week's low, there was that middle of the week where we breached last week's low, went down, but then there has been a recovery and the bulls will hope that at least continues. In terms of flows, well, not much different to report. Once again, selling from FIIs, almost 5,500 crores. Domestic institutions buying about 3,700 crores. Lots of earnings in focus. We'll talk about this as we go along. It's a mixed bag. Yesterday, the mid-cap IT space rallied big time. Let's see, because today's mid-cap IT numbers are not that hot. Dr. Reddy's is also mixed. They have a problem with the US as the generic version of Revlimid starts tapering off. So that's showing up. There's margin pressure there as well. On Ascent, like I was saying, the numbers are not as great. They've actually cut their guidance as well. So yesterday's, fanfare on mid-cap IT, whether that continues or not today, we will see. Amber is a very strong set of numbers. They have been filling up the channel inventory on room ACs ahead of the summer season. Numbers are looking very, very good. And United Spirits has ended December on a high. Yesterday, Mangalam was telling us about maybe 9-10% volume growth in their prestige and above segment. It's even better than that. Even the popular segment has done well. So I think the December cheer is rubbing off, at least USL for sure. But we will see, Nigel. What about the overall market setup? How do you look at it?
Well, just since you spoke about a couple of sectors and segments out there, I'll tell you what, I was looking at some data with regard to steel, cement movement via rail. That is slowed down. If you're looking at power demand as well, it's slowed down as well. So January actually has been a soft start on the economic front. So we'll have to see some action both from the government of India as well as from the RBI. And that's something that the bulls will want to latch on to.
And today, a big steel number for you as well. We'll watch out for this one as well.
Indeed, but that's more backward facing, right? You'll want to hear the commentary and understand what's going ahead. But let's focus on, a couple of data points. There's close to around 6 trading sessions, or 5, including today. And the bulls, they'll want to keep that 24-year record intact. What is that? We haven't seen 4 straight months where the Nifty ends lower. And that's, we appear that we're on course for that, 1.9% lower as of now in the month of January. So the bulls will say, well, we have got close to around 6 trading sessions. We want the Nifty to pull back close to 2%. That's approximately 400, 425, 450 points or thereabouts. So the bulls will want to keep this 24-year record intact, which means effectively that we do see some kind of pullback from where the last time around we saw this was in 2001, when we saw 4 straight months that the Nifty ended in the red. The good news was that yesterday there were first signs of short covering from the FIs, both on the index futures as well as on the stock futures. So yesterday, in fact, you did see on the index futures short covering being seen out there. On stock futures as well, there were some shorts that were covered. And you want to see more of the same because they have been stacking in the shorts into the system. The options data comes up in the screen, the 23,000, both the 23,400, 23,300 call, both of them were fairly active, which gives us the broad levels that we're looking at. Support comes in at around the 22,900, 22,950. Remember, we almost visited that earlier this week twice, and we bounced back from that. So that's a very, very important mark. On the upside, you're expecting some resistance around this 20 DMA mark, which comes in at around 23,550 odd. In the near term, going by the options data, going by the technical levels, that's the range you're looking at. The Nifty Bank yesterday ended mildly lower in yesterday's trading session, but the good news yesterday was it made a mildly higher high. It made a mildly higher low as well. So you'll want to see more of the same even on the Nifty Bank because that holds the key going by its weightage. One stock that I'll be looking at and comes out with a set of numbers which has been a rank underperformer is SBI Cards. That one, in fact, year to date on the last 1 month or so, it's actually done a relative outperformance. If I look at SBI Cards, that's over the last 12 months. But in the last 1 month or so, you have an outperformance coming from SBI Cards. Keep an eye out on this one. It's seen some bit of consolidation for the last few days.
Nigel, thank you very much for that. More stocks coming up as we go through the paces over the next 2 hours or so. We have Hu Kian Yap, Senior Investment Strategist at Standard Chartered Bank, now joining us to take some questions. Hu, good to have you with us here. Thank you for your time. Appreciate it. So I just want to start with the effect on oil. Trump is asking OPEC to increase supply. And that is meaningful for large importers like India. If the price drops, it's been north of 80, and now we're at about 78. If this were to turn into a bit of a reality, it's very meaningful from a macro point of view for countries like India. Just your thoughts, you think it's going to come to pass?
Yeah, we know that the Scott Bessent, which is on the Trump's advisory team, his point, one of his 3 arrows was to have lower oil, and then that would actually help with inflation coming down, and that would be supportive for the US. Now, he wants to lower oil by increasing production, and that is a bit of tricky things because producers will want to see higher oil prices in order to increase production. So they actually plan to increase production. He's made the comments to other partners, other producers around the world for them to increase oil production. We'll see whether that comes true or not. But within the US, they also want to increase production by lowering the cost, making it easier for the drilling rights to go through in the land. So it depends whether you can actually achieve it, because at the end of the day, we think that producers want to see higher oil prices in order to produce more oil. But by lowering the cost, we think possibly it's something they can do on the margin. So it is definitely part of the strategy of what he wants to do. I think the execution part is a bit trickier that we need to see. But clearly, if he manages to bring down oil prices, brings down inflation, and that actually smooths out a lot of things because the market has been very worried about Trump's policies and its impact on inflation.
Yeah, absolutely. Fu got that point. I want to get your sense on how you're sizing up a lot of the Asian countries and Asian markets that are, trying to prep for a tariff war if it were to happen. Look at what Singapore's done this morning. And they're using currencies, right? China's been letting the yuan depreciate. This morning, we've seen the moves out of the Monetary Authority of Singapore. And I wonder, today's Bank of Japan. Now, will the Bank of Japan be able to hike interest rates hours after the US president says the world should have lower interest rates? Your thoughts?
No, thanks for that. I think, there's a lot of uncertainty in terms of this America First policy and how that impacts the rest of the world. We think that, the tariffs that he's been coming out with, in fact, in his first week at the office, it's probably come out a bit less bad than people expected, especially on the Asia front and on China, the comments that he has made, compared to 60%, which was promised during the election campaign. It's come out a bit softer than expected. Of course, we remains to see because it can change very quickly. But that is something that we'll need to watch. And we do believe China actually has the ability to respond in terms of the policy stimulus, but it's waiting to see what Trump unveils first, and then whether they can come to some kind of negotiation before they will do that. Now, in terms of the, I think that in terms of what Japan is going to do, I think pretty much the market is already expecting that they will be hiking. It's just the guidance after that. Their expectation is that they will hike and then be cautious and watch the data after that. So as long as they stick to that, I think the market is happy with that because that is what has been guided to expect in line with expectations, really. But for Asian countries, I think very much seeing how Trump wants to roll out his policies, and then they will try to respond.
All right. Hi, folk. Good morning. Good to see you in. One risk is with regard to Trump is he doesn't go as harsh out at China in comparison to what global markets were expecting. And that could be a bit of a negative for the Indian markets because, we were expected to be a bit of a beneficiary. And, hopefully we were, that Trump will be better to India in comparison to other emerging markets. That said, our markets have gone through a period of consolidation and a price-wise correction as well. What's your view on the Indian markets? On one hand, we have an economy that's slowing down a little bit in comparison to what we've seen in the past. The other part is that this is not a structural problem. So longer term, India could still look up. Your view on India, is it a buying opportunity?
Yeah, India is our favorite market in Asia. We think it is a buying opportunity. So that's a straight answer there. It's still delivering 14-15% growth this year and next year, 2025, 2026. So we think it is leading in terms of the structural growth that it can offer. Look, it has come off the correction. We think it is an opportunity to buy on dips. Now, the catalyst of what could change that, could reverse that. I mean, there's a few, but I think the main one will be looking at the earnings estimates, whether they can stabilize, because we've seen the 2025 earnings estimates at consensus actually coming down. We need to see that stabilize before the market gets more comfortable with it. There's things like the dollar, US dollar, which has been very strong. If that comes off, that could help as well. The oil price you mentioned already, that is something that's positive. But really, I think we need to see earnings estimates stabilizing for 2025 before the market can actually bounce on the back of that.
Okay, all right. Fook, we'll leave it there. Thank you very much for joining us and running us through all of that. Appreciate it here on CNBC TV18. Well, time for a quick commercial break here, but there's lots of stocks that we want to get to very quickly. It's our top 10 segment. We look at names which should react pretty positively. HPCL has reported a very good set of numbers. Indus Towers should be up and about. United Spirits, Emphasis, Amber are the other names on that green list. Dr. Reddy's, Mankind Pharma, Cyient, Ujjivan Small Finance Bank and Spandana Spurti are stocks on the red list, as you can see up on your screen. So that's coming up in just a bit.
So it's a very happy morning across Asia. At least for now, most of the markets are holding up in positive territory. Gains range anywhere between, a 0.25% to about 1%. And therefore, the implied open is suggesting that we will also build on the recovery that we've seen over the last 2 days, 55 points higher. What about individual stocks? As usual, a ton of earnings to go through. So we have our team standing by with the CNBC-TV18 list of top stocks to watch. Let's kick it off. Hi, guys, and happy Friday to all of you. We'll kick it off with Dr. Reddy's first. Vinny, not looking too good.
Yes, so in terms of numbers that have come out for Q3 FY25, not looking that exciting because we're seeing a miss that's come in on the profitability front. Revenue is in line with the CNBC-TV18 poll. But why the miss in terms of revenue growth? It came in at 15% overall revenue growth. India sales, decent growth that we saw. North America business, that was down almost 10% on a quarter-on-quarter basis. It's expected because the Revlimid sales are expected to start seeing a bit of an impact coming in and decline coming in. So because of that, North America sales on a quarter-on-quarter basis have been weak. India sales, like I was saying, we managed to see a decent growth of 14% on a year-on-year basis. What was aiding it? The acquisitions that they made recently. So Sanofi vaccine also is something that is the deal over there, plus the JV with Nestle is something that is supporting the growth in India business and overall the base business of the company. What didn't do well on the India side was the cardio as well as the gastro therapies. That was a bit weak. So in terms of core business in India side, that was a bit of a weakness or a slight bit of a blip on that front. EBITDA margins, they also saw a bit of an impact coming in. We saw a contraction in terms of EBITDA margins on a year-on-year basis, mainly due to the incremental competition in certain products, increase in some of the costs that are seeing and spends over there, as well as Revlimid sales that have been a bit weak, impacting the overall margins of the company. So that is why we're expecting red for Dr. Reddy's.
Okay, thanks a lot for that, Vinny. And we'll connect with the management of Dr. Reddy's in a short. Stay tuned for that conversation. Well, let's hop across to Sudarshan. He's been on top of a lot of these stocks, and he's here to tell us about HPCL. Sudarshan, how are the numbers?
If compared with BPCL, earnings for HPCL are looking better. Earnings were largely in line with estimates. So some of the factors that have worked: first, both marketing and refining margin have seen an improvement on sequential basis, and marketing business, which is the higher contribution amongst all the OMCs. So volumes for the marketing segment have 11% QOQ, and refining margin was in line, and HPCL's GRM is higher than BPCL's GRM for the first time in last 4 years. And some of the factors that have not worked: first one is LPG under recoveries. Under recoveries have increased to 7,500 crore as of December from the level of 4,500 crore that company had reported as of September. And second, company is sourcing crude at a premium after Russian sanctions. Talking about the numbers, profit has come in at rupees 3,203 crore versus pool of 2,900 crore. Revenue has increased 10% sequentially. Has come in higher at almost rupees 6,000 crore versus pool of 5,800 crore, and margin has increased 4% versus 2.7% that company reported last quarter, and GRM has come in $6 per barrel versus $3.10 barrel that company had reported last quarter. Though they may have a mixed views. First one, Jefferies maintains underperform call. Target is 295 per share. It says LPG subsidy could drive earnings up. 450 per share. It says all eyes will be on budget for compensation to OMCs for LPG losses. But I'm going with green because earnings are in line with estimates.
So thank you very much.
Inline set of numbers versus estimates. We cannot compare it on a year-on-year basis or a quarter-on-quarter basis because do not forget we have the BSP integration that has taken place in October 2024. So because of that, the numbers would look higher versus last year or last quarter. Revenues versus estimates in line, margins also largely in line. Profit is where we saw the decline coming in, and mainly that profit decline was due to higher finance costs. This time the finance cost was at around 221 crores. Higher debt is something that is impacting the company because of the BSV integration. So finance costs are the main reason for the decline that we saw coming in terms of profits. Domestic sales have remained quite good in terms of the performance, while the domestic prescription sales also saw growth in terms of overall the performance of the company. So yes, inline set of numbers, but maybe we could see a bit of a red coming in on the screen right now.
Okay, all right. So Mankind will be prepared for maybe that bit of red, like you're saying, Vinny. Let's go across to Rima. Rima, actually, yeah, we'll come to the IT companies in a bit, but let's first start with Indus Towers. How was the performance?
Well, the key positive is that from Vodafone Idea, the company has managed to recover 3,000 crore rupees. So there is a reversal of doubtful debts to the tune of 3,024 crore rupees. And this has pushed up the company's margins and profits. That's the key positive. So on the top line, revenue growth is flat, just up 1.1% sequentially, up about 5% on a year-on-year basis. But look at the EBITDA number. The absolute EBITDA is at 7,000 crore rupees. EBITDA margins at over 90%. Profits have gone up 80% on a quarter-on-quarter basis. If you adjust for this, then according to analysts, numbers are in line. The second positive is the free cash flow generation, which Citi points out is strong in Q3 at 2,700 crore rupees. They expect Q4 free cash flows to also be strong, which means the company could just pay out a 20 rupee dividend. The stock has been doing well. It's seen a lot of brokerage upgrades too in the last couple of, since the beginning of the year, and these numbers are strong.
Okay, all right. Thanks a lot for that, Rima. Well, it's a Friday and Mangalam joins us to tell us about United Spirits. Mangalam, ironic, right?
Well, what can I say?
The teetotaler on top of it. Mangalam, tell us, but those numbers look good.
These numbers look very strong, Nigel, and it may be a Friday cheer for United Spirits itself. Why do I say that? Because, you know, if you look at the revenues, 14.4% revenue growth, much above street expectations of around 12 to 13 odd percent. And it's led by prestige and above volumes, which came in at 11.2% versus street expectations of 9 to 10%. Revenues also grew by 16%. Again, street expectations were 14 to 15%. Popular, something that the company is not focusing on as much, that too grew by almost 6% from a volume standpoint and 10% on a revenue standpoint as well. So from a top line standpoint, it has been very strong. One would say, why is it that the EBITDA and net profit are then below expectations? It's because, the company has spent a little more on advertising this time around. Remember, it has been a seasonally strong quarter for companies, so they've ramped up ad spends. Gross margins have improved, so that's a positive. The net profit is below expectations, largely because of a 65 crore exceptional charge. Add that back, and the net profit too looks pretty strong. So my sense is that after the recent correction that we've seen in the stock price, we may see a bump up in today's trading session. All eyes will then be on the conference call that takes place at 4 p.m. This evening.
Absolutely. So set for a high, perhaps this is Friday, the share price. That's what I'm saying. At least the opening should be optimistic. Mangalam got that. But now back to Rima. Rima, your mid-cap IT players were sparkling yesterday. They were lighting up the market. But now this morning, Memphis and Cyient, not that hot?
Well, Cyient is not hot. There are two negatives in Cyient's numbers. One, a guidance cut on both revenues and margins, and two, a CEO exit. So first on the top line, for FY25, the company's cut the guidance from flat revenue to minus 2.7%. And the key reason is right shifting of projects, which basically mean projects got delayed. And secondly, the margin guidance for Q4 has been cut from 16% to 13.5% on account of aggressive wage hikes. So that's reason number one, guidance cut. And secondly, the CEO, Mr. Karthikeyan Natarajan, has stepped down effective immediately. His term was for 3 years, but he stepped down in less than 2 years. That said, in the conference call, the company, the management commentary was fairly upbeat about the deal wins, growth coming back, the pipeline, etc. But JP Morgan today has downgraded the stock. Now, Emphasis, on the other hand, is an okay set of numbers. So on the top line, slightly lower than street expectations with a growth of about 0.2%, but the other internals are fairly strong. They've managed to maintain margins at 15.3% within the company's guided band. The deal wins are very strong. Deal wins have inched up to $351 million. That's a sharp jump. The large deal wins are the highest that we've seen in the last 6 quarters. Not just that, in January itself, they won a $100 million deal, which will kick in Q4. And the company, in their in the commentary, says that they will maintain above industry growth rates, and margin band of 14.6 to 16% is intact. So Emphasis slightly soft on the top line, but the other internals look good.
Okay, all right. In fact, we'll have the management of Emphasis who will be joining in later on the show. So we'll try to get further clarity with regard to the past quarter's numbers as well. But let's hop across to Upasana. She's here to tell us about Amber. How are the numbers, Upasana?
Well, certainly a strong set of numbers. It's a beat across the board. Revenue, EBITDA margins, PAT, all three above the poll estimates. Now, this strong performance was mainly driven by RAC demand, channel and inventory filling in anticipation of positive summer season. Now, let us look at the numbers first. Revenue stood at 2,133 crore with an uptick of 65% on a Y&Y basis. And this revenue growth was mainly driven by company's consumer durable division, which reported a strong revenue growth of 96%. and margins also increased by 160 basis points at 6.1%. Other divisions such as electronics, the revenue grew by 1.4 times, while railway subsystems saw revenue decline of nearly about 13% on a YoY basis. Now, EBITDA stood at 159 crores for the company with an uptick of 1.03 times, which was much above our poll estimates, leading to a margin expansion from 6.1% to 7.5%. Mind you that this overall margin expansion of 140 basis points was driven by company's RAC margins. And lastly, coming to PAT, it stood at 37 crores versus the loss of 0.5 crores, which was much above our poll estimates of 23 crore. So all in all, strong set of numbers coming in from Amber Enterprises in its Q3 FY25.
All right. Thank you very much for that, Upasana. Let's talk about financial services now. Ujjivan Small Finance Bank and Spandana Spurti are the ones we want to address. Abhishek is here with details on both. Abhishek, morning.
Morning, Prashant. So stress in rural or, MFI book has weighed on the performance of both these lenders that you have mentioned. To begin with, Ujjivan Small Finance Bank, they have given an update that they will apply for universal banking license in Q4 FY25. 7-quarter high with respect to gross NPA ratio coming in at close to 2.7% versus 2.5% in the previous quarter. The slippages are elevated at about 359 crore versus 238 crore in the previous quarter. Annualized slippage ratio has inched up to 4.7% versus 3% in the previous quarter. So multi-quarter high with respect to slippages as well as annualized slippage ratio. Net interest margin is at 13-quarter low, while return ratios, that is ROA, has fallen to 1.2%, which is a 12-quarter low. Spandana Spurti, it's a disaster of a number that you are seeing over here. Disbursals are down 43% YOY and about 4.7% sequentially. AUM is down about 14% YOY and about 15% sequentially. The net interest margin has declined as well, both YOY and quarter-on-quarter. The net interest margin has declined. The write-offs, now this is very important, the write-offs are at 678 crores versus the gross NPA in the previous quarter being around 477 crore. Last, I have not seen this kind of a write-off, that write-offs are higher than previous quarter's gross NPA in, BFSI sector. So return ratios, ROA minus 16.2%, ROE minus 52.4%. Net interest income is down 14.7% YOY and about 24% sequentially. They have more than tripled their losses in, quarter-on-quarter basis. So they have reported a loss of 658 crore versus 203 crore in the previous quarter. Back to you.
Okay, all right, got that, Abhishek. Thanks very much. Let's quickly recap our list of stocks to watch today. The ones that have positive news around them are HPCL, Indus Towers, United Spirits, Mphasis, and Amber Enterprises, all these positive earnings. The ones that have some negative news flow around them are Dr. Reddy's, Mankind Pharma, Cyient, Ujjivan Small Finance Bank, and Spandana Spurti. Okay, so that's the stock list. Now let's take a look at the commodity market action overnight. We've got Manisha Gupta joining in with the latest. Manisha, good morning.
Morning, and thank you for that, Surbi. Well, major cues coming in from the crude oil prices there, where we are headed for a sixth straight daily decline there. And when you look at this week as well, this is the worst weekly performance that crude oil is putting since the month of November. We're down by more than 5% for both these varieties, and much of this comes in on the back of U.S. President Trump's statements, especially in Davos as well, as he said that we are looking to increase more production, especially in U.S. when it comes to offshore and onshore drilling. He also said that Saudi Arabia and OPEC should work towards lowering the crude oil prices. The Chinese demand concern is still weighing onto the market. And then with the kind of ceasefire that we are seeing in Middle East, that premium also seems to be getting away from the prices. Well, the charters tell us that it is slightly oversold right now, but if Trump continues to reiterate the kind of statements we are hearing from there, you could be looking at further decline coming in for the crude oil prices. We're looking at $74 a barrel holding for the WTI prices right now, but the markets do believe that 72, even 70 on the lower side could be on chart.
Oh, okay. All right, Manisha, got it. And who's to say U.S. President is rooting all out for lower oil prices, and I think the market's actually following him, at least for now. Thank you very much for the details. We'll come back to you in a bit. Let's now get our first corporate conversation going, and we're talking about a nifty company right now as the earnings season plays out. Dr. Reddy's is in focus. Now, for the third quarter, revenue came in line with estimates, but profit was a miss, and margins also came in under pressure. So what are the trends as we're looking at the remainder of this year and more importantly going forward? We have with us Mr. Erez Israeli, CEO of Dr. Reddy's Laboratories, joining in. Mr. Israeli, thank you very much for being with us this morning. And I really want to sort of, cut to the chase and get to the U.S. business, because that's where the disappointment has been. Your North America revenue is down a little over 9%, and there's a lot of concern about how you will make up for the fact that your revenues from Revlimid, they'll keep declining. So what is the outlook on the base business?
So nothing big is. I think also anticipate that it will continue to do well. It's the normal behavior of the market. We are going to launch 15 to 20 products a year. We are going to continue to see sales of linadulamide. This is the generic Revlimid. We are going to see also a competition in certain products. So overall, nothing special happened in this quarter, and I anticipate also that it will continue the same way also in the future.
Okay, point taken. You mentioned competition in certain products. Does it include, Suboxone and Vascepa?
So you got it correctly. These specific products do have competition. There is no change to the competitive landscape of these specific products in the last quarter. But normally, when product is big, other products, other companies are joining. This is the nature of the game, especially in generics in the United States. And we face competition in these two products as well as actually in every other product. And this is likely to continue, but it's nothing out of ordinary. We will need to continue to grow the base business primarily by gaining market share as well as launching of new products.
There are some reports which are suggesting that you're actually losing share in Suboxone and Vascepa. Is that the case? Can you tell us?
Before the competition entered to these specific products, which was around 6 to 9 months ago, at that point of time, indeed, we lost some market share to the new entrant on this product. This is correct. Overall, it's a normal behavior that is happening in every product.
All right,
in the market. This is the nature of the game.
Got it. All right. Just another question on margins. They have been under pressure. Will this 27% be a sustainable level with regard to margins?
So we normally are saying the 25% is a place that we feel comfortable about. That sometimes because of mix we can be above it and sometimes below it. The 25% allow us to invest enough for the future, as well as to give enough total shareholder return, of course, to the shareholders. So as long as we are in that range, and of course if we are above that range, we feel very comfortable about it. We should expect that kind of range to continue, and that's what we are normally aligning our investments and expenses in order to achieve that kind of margins.
Mr. Israeli, the European business grew at a healthy clip, almost 22% year on year. So what is driving the growth there, and what's the launch pipeline looking like?
So we are launching products in the countries that we are operating it. We are operating in many countries in Europe, but primarily in what we call the Big Five, and the biggest market out of that is Germany, followed by the UK. I believe that these markets are performing well. So most of it is coming from these two markets. Specifically for the biosimilar, we launched bevacizumab in the UK. It was successful. Rituximab was not launched yet. We received the approvals, and we will launch later once we will complete all the relevant logistics activities. This is yet to be launched in the UK.
Right. What are the potential approvals, launches in the US over the next 12 to 18 months, which could drive growth for you?
So we have 4 growth engines when we are talking long term. First of all, in terms of product type, we are going to grow the generics. I will mention also what type of product in a second. In addition to that, we are nurturing and growing 3 types of businesses, which are consumer care, biologics, and innovation. Now, just to give example in each one of them, in the generics, it's primarily about complex product, the type of the peptides, like the GLP-1 product, and or other products which are long-acting, injectable, and stuff like that. This is in the pipeline. If we are talking about consumer care, this is primarily inorganic. It's the NRT business that will grow. It is the Nestle deal that we made, and we will launch and grow this business. And we are planning more activities like that also in the future. In biologics, the main products will be, after rituximab, will be denosumab, followed by abatacept, followed by other products that will come later. In innovation, for example, we launched toripalimab in China, and we have many products like that that will go. So if you wish, we have multiple growth drivers. It's not 1 or 2 products that will make it happen. We will grow the base. We will be more productive. We will have special products like the names that I mentioned, and we have BD. So the combination of all those levers will continue to grow the company consistently also in the future.
All right. So I wanted an update on the facility in Hyderabad. If you could tell us, what's the update out there?
Indeed, we got 7 observations. We answered all of them in the stipulated time. And we are expecting now the response from the US FDA. We are optimistic that it will be positive.
All right. And so now everyone's, of course, talking about GLP-1, right? And apparently Dr. Reddy's also has an interest in participating in the first wave of the launches. Can you tell us more? What exactly are your plans and what are the timelines?
So 2026 is the year in which the market will start to be opened up in terms of IP, in terms of patents. The main countries in 2026 will be Canada, India, Brazil, and 80 more countries that are relatively smaller, in which, as we speak, there is actually no patents, and these markets are open. We are planning to launch the product in many, many countries, including the countries that I mentioned. And as other markets will be opened up in terms of patents, we will launch also in those markets as well.
Now, finally, sir, could the R&D spends moderate after completion of the abatacept trials?
So just to clarify, the abatacept trial is not done yet. We load the last patients. We are very happy, but of course, the trial continues, and we are expecting results that will enable us to submit sometime next year. So it's still ongoing. Specifically, it's more indeed timing of trials, not the specific product, but timing of other trials. And give or take, we should expect to see similar level of R&D, somewhere between 8 to 9% of sales. This is likely to be the magnitude also in the future.
Okay, all right. We'll leave it there. So thank you very much for your time, and good luck to you, your team, as you continue to execute into the rest of the year. Thanks. Appreciate it very much here on CNBC TV18. We'll take a quick commercial break here. Devin Choksi will be with us to talk about specific stocks that he'd want you to keep an eye on, stuff that looks interesting. Lots of earnings, and we'll get some of those reactions from him on the other side.
Welcome back. Hope you're having a good Friday morning. To help us out with some of the stock analysis, Deven Choksi, the Managing Director at DR Choksi FinServ, joins us on the show. Hi Deven, good morning. Good to see you in as always. Well, let's start off with a few stocks. We just spoke to the management of Dr. Reddy's. Numbers looked a little bit subdued. What are you making of the stock?
Good morning, Nigel. Well, I think on one side, the numbers and the margins particularly, I think will look a little subdued, given the intensity of competition in some of the generics. But what is the important key takeaway from the management commentary? The regular launch of new products and at the same time spending money on biosimilars and complex generics. I think that's what the future roadmap that the company has laid down. Given the size of R&D spending, given the new launches that they have, probably I would like to think that the business in absolute terms, may not be remain same, on a quarter-to-quarter basis. But over a longer period of time, you would distinctly see the larger pipeline of products, which could possibly give the better visibility going forward. Maybe currently everything is in price, so there is nothing left as far as the upside is concerned. But as far as the growth prospects are concerned, the roadmap is relatively more clearer than before.
Okay, that's Dr. Reddy's. Deven, hi. Good morning. Good to have you on the show. Mid-cap IT. And I think the market's been realizing this over not just this quarter, but the last many quarters, that if you want to back growth, then, there are other stocks well beyond your usual TCS, Infosys and Wipro. Now, what do you think? Coforge has been going very strong. The stocks also rallied, but the management commentary is also very good. There's also Persistent. Cyient is not that great this morning. They seem to have a couple of issues, including management change. What do you like in mid-cap IT?
Yes, Sudhi, good morning. Well, I believe that some of the mid-cap IT companies which are having a larger amount of thrust towards the engineering space, particularly, they would relatively be better off in coming period. Because each of the verticals, be it healthcare, be it automobile, be it aviation, and to name few, these are the verticals in which some of the companies like Tata Technology or for that matter Tata Elxsi, they are focusing. Of course, on a quarter-to-quarter basis, the results are not showing up on every aspect, but at least they have been winning larger amount of orders. The size of the order win that they are having compared to the previous quarter has been on a higher side. And that gives the promise that the delivery will be much better going forward in coming quarters. So we like some of the niche plays, and they are going to produce comparatively better performance to their peers in the last year. So selective companies from investment perspective, good time because the market has corrected on the price side.
Okay, Deven, I want to ask you about Indus Tower as well. But, have to take a quick break, so allow me to do that. We'll just come back and talk more stocks with Deven on the other side. Stay tuned. Okay, welcome back. We've got, there you go, at the bottom of the screen, Japan has hiked interest rates by 25 basis points, 0.5%. That is coming in as we get closer and closer to the market open now.
Clearly not paying too much attention to Mr. Trump saying all rates should move down and everybody should follow the US.
Yeah, no, absolutely. And, the thing, of course, is it going to show up in the currency in a significant way or not? Because that we'll have to see, because that will influence whether it has any financial market impact, whether, it triggers a risk off. I don't think so. There is a press conference scheduled later as well. And broadly, the expectation is, well, they've done this. And, the governor of the Bank of Japan said he'll do it 2 weeks back, basically. The general expectation is that at that press conference today, he will sound dovish. I don't think he'll indicate any rate hikes beyond March of this year. And of course, the context is that Japan is completely skipped this entire global rate hiking cycle, right, which started in 2021. And, it stayed where it is, near zero. So now as the rest of the world is thinking about cutting, and that may not happen. For example, in the US, there are no rate cut expectations. Japan is now thinking that maybe it needs to increase rates a little bit, just a little bit, about 25, and it's still 0.5%, by the way. Dollar rupee, I'm not sure if that's live, but there's no real reaction coming through. It's still at about 156.19 or so this morning. Devin, 30 seconds. I just wanted to slip in Indus Tower to you. Do you think it'll see some recovery here? Has been beaten down quickly?
Yes, Prashant, absolutely. I think collection from Vodafone about 300 crores, and also expanding the towers. I think also Vodafone is buying further amount of capacity. All in all put together, I think the operation numbers are likely to remain better going forward.
All right, 366, and we'll get the indicative pre-open rates in a bit from now. Devin, thank you very much. Appreciate you staying on and sort of running us through those individual names and, of course, your overall thoughts as well. We'll take a break. We are back with the pre-open. Mitesh is going to be with us to discuss technical trading ideas.
Welcome back. Just under 14 minutes to go before trade kicks off. We've started getting the first of the rates and, they're just settling in. So are the currency markets as the BOJ hike sort of settles in. But it's a long expected line, so no major moves. That's the Nifty. Let's pull out the dollar index as well. It's been hovering around 108. So, I mean, it's all pretty. The dollar rupee rates will come through in the next couple of minutes. But the DXY has been extremely range bound, closer to 108 over the last couple of days. And that is the picture that continues. For us, the Nifty right now is down about 63 points. Let's see how this stabilizes. The dollar index has fallen a little more, actually, after the announcement from the BOJ. The DXY has slipped below 108. That's interesting. Okay, and that's the Nifty, which is down about 60 odd points. So now, how do you look at positioning and trades? Let's go across to Mitesh for that. Mitesh, hi, good morning. So, index stocks, what is it that you're going with this Friday?
Good morning, Sudhi. Maintain a range-bound kind of a bias, 23,000 to about 23,350. So I think we might try and head towards the upper end of the range. Having said that, we focus on stock basis. I have a buy on Ambuja with a stop at 540 for targets of 566. Sun Pharma reversed well yesterday, so that's a buy with a stop at 1809 for targets of 1875. Also a buy on Indus Tower with a stop at 358 for a first target of 380. And Eicher Motors is the final buy call. Keep a stop below 50.50, look for targets of 52.80.
Okay, all right. Mitesh, we'll sort of just come back to you for more in terms of specifics. I don't think we'll get those rates as we open up, as you're seeing at the bottom of the screen. But there's just the first 1-2 minutes of the pre-open, should settle down in a bit from now. Now, the paints industry is heated up with new entrants like Birla Opus, says Parth Jindal, Managing Director of JSW Cement and JSW Paints. This is on the sidelines of the World Economic Forum in Davos. He also spoke about consolidation in the cement space. There was a bit about their bid for Akzo Nobel India as well. He was in conversation with my colleague Shireen Bhan. Listen in.
Mr. Gadkari is back again making his comments as far as cement cartelization is concerned. He's been saying this for the last several years now, in fact, going back at least a few years. How do you respond to the charge that there is cartelization within the cement sector? And this is something that the Competition Commission has not just looked at, but has also delivered a verdict on previously.
So I can't comment on what's happened in the past, but right now I can tell you that the cement industry has been given a very bad image for no reason. If you look at the CAGR of price growth in the Indian cement industry over the last 10 years, it's less than 1%. In fact, cement is cheaper in India than potatoes are, right? And I think we need to ask the question as to why this image is there when large companies are making losses in the cement industry. So I think there is some sort of a misconception here, and I can say it, very confidently and with a lot of sincerity that there is absolutely no truth in these claims.
Well, the government will perhaps go back again to the CCI, and I understand that the CCI is currently also looking at a previous complaint, but as I pointed out, this is not something new that Mr. Gadkari said. But given what you said, that competition at an all-time high, profitability at an all-time low at this point in time, how does that then back up the kind of expansion plans that you have?
No, I think in terms of India as a growth story, there's no doubt that the cement demand, the steel demand in India is only going to grow. This is a temporary phenomena where people are in a quest to consolidate, keeping prices, according to me, in a quest to consolidate, the large players are keeping prices artificially low in order to squeeze out the marginal players and consolidate the industry. If you want to remain relevant in cement, you've got to have at least a 10% market share. Otherwise, there's going to be a threat of consolidation even on your company. So if I don't get there, I'm a very big target for the bigger guys. So I think it's a balance that one needs to create. And also, if you look at our expansion plans, we are expanding only in those geographies where we're seeing a supply-demand equilibrium. And we're seeing that, we can enter that space. Now, if I were to add more capacity in the south or more capacity in the east, I think that's not really required because there is an excess capacity. But in markets like central, north, northeast, if you expand there, I think it'll get consumed.
So what is the current market share, even though that you said that the needle isn't moving too much at this point in time, even with all the competitive intensity, but what is your current market share?
Oh, it's very small. We would be about 3.5% on a pan-India level. So if Indian cement demand, we would be about 3.5%, and our ambition is to get to 10%, and that's going to be happening over the next few years.
5?
By 2030, we should be 10%.
By 2030 is the expectation. Let's also talk about the paints business then. Similar story, I would imagine, that's playing out for cement is also impacting the paints sector today. Where do you stand on that front? Because again, that's also gotten fiercely competitive.
Yeah, I think with JSW first and then Birla's entering, I think the industry has definitely heated up, and it's led to the first bout of consolidation with AkzoNobel putting its India assets on the block. So I think today, we are a 5.
Did you consider looking at that?
We just submitted our bid.
Okay.
We submitted a non-binding bid. The first round's bids were submitted on the 22nd of January. So we are very much looking at that asset. So we are today, 2,500 crore company, 5th largest in the paint space, and we are a 5-year-old company. Obviously, there's been a lot of noise with the entry of Birla's and the kind of investments that they have made, and we've all seen what's happened to the market share of the larger players. We'd like to think we played a small role in that, and Mr. Birla played a bigger role in that. But overall, I think my true belief is that the paint industry is not a winner-take-all market. It's not a capacity-driven market. You can't just build plants and expect the consumer to choose your paint. I think there's a lot of brand equity that has been created over the years by the incumbents. And this is an industry where you need to win the micro battles. You need to win over the influencers, whether it's the contractors, the painters, the interior designers, the architects, and finally the end consumer needs to select your paint. So it's been an interesting journey. It's completely B2C, and it's the first time JSW Group had gone into B2C. Now with automobiles, it's the second one. But it's exciting, and I think the AkzoNobel opportunity is a really exciting one. And whoever gets it will really have a shot at being in the top 3 for a long time.
So, we don't know how that will pan out, but of course, as you pointed out, you've already put your bid in. But, the synergies between the cement and the paints business, as you kind of grow both these out, what do you see happening on that front?
So, the synergy is not much on the grey cement business and the paint business. There is synergies on the white cement business and the paint business, because the putty, which is made to prepare the wall surface, is made out of white cement. So hence you have players like Birla's and JK entering paint, because they had the distribution network of the white cement.
Right.
They being the largest players. Now you have Asian Paints entering white cement. You have JSW entering white cement as well, more as a defense mechanism to protect our network. So I don't see much of a synergy from a network point of view for our cement and paint business. However, from a real estate point of view, from a B2B point of view, today we are selling our steel, our cement, our paint as one offering to all the large contractors and large real estate players. That's resulted in a lot of success for the group because we can offer it as one suite, and if they do a certain volume, if they do a certain value, they get a discount on the whole basket of products. And we heard a lot from our real estate players that, dealing with separate companies is such a pain. Why can't you just be creating a one-stop shop solution? We've also launched JSW One in order to offer this online. So this is helping us grow faster than the market.
Well, Mr. Parth Jindal, saying it as it is, wants to be a 10% player in the cement market. He's currently at around 3%. He believes that's important to stay relevant. And in terms of cement prices, you heard what he had to say. He doesn't believe that cement prices are at any kind of elevated levels. In fact, to be fair, the last 4 years I've not seen too much of a price move, and now gradually you're seeing a 1% or 2% movement in cement prices. So interesting space, cement as well as paint. But the more interesting space is drinks. Mangalam joins us to tell us about United Spirits. Mangalam.
Well, I don't know about the volume growth in cement and paints this time around, but definitely the volume growth in drinks has come about in United Spirits. 11% volume growth in P&A and close to 6% in popular segment as well. The company said it was driven by resilient consumer demand in peak festive season. Also, the fast scale-up that happened in Andhra along with value, writing as well as duty reduction in Karnataka. So all these factors played their role in this performance. But remember, the stock over the last 2 trading sessions has rallied about 5% after having fallen about 7% this month and 12% from its peak as well. Still trading at around 64 times. Brokerages, they like these numbers, but they haven't put pen to paper until they listen to what the management has to say in the conference call. But Investec, for instance, has a target price of 1647. Goldman Sachs says that, the acceleration in volume and revenue growth in a tough consumption environment is positive. They have a target price of 1650 as well. 4 p.m. today is when the conference call is. The commentary on the fourth quarter demand, outlook on new categories, and leadership transition from Hina Nagarajan to Prameen Someshwaran is something that we'll most definitely keep an eye out on.
Okay, all right. Interesting one, Mangalam, and we'll keep an eye out on this as this market start to trade. What do we have in the United States? 2.33% higher this morning. Let's just also look at some of the other names, right, which were coming through. So we've got, we should look at, names like Dr. Reddy's, just the first rates in the pre-open, how that is starting. HPCL, we should put up, DRL is down 5. HPCL will come up on your screen. That's about 3.33% higher. Strong numbers as we highlighted earlier. Mankind is another one which we should look at, reacting to results. That's Mankind Pharma. Indus Tower comes up next, 3% lower on Mankind. Indus Tower is should start higher, but a bit nothing, 0.5%, 50 paise higher on that one. Emphasis and Cyient, of course, but these stocks did very well yesterday. Emphasis was up sharply, but the entire mid-cap IT space was up sharply. So there is that to boot. So 2% lower on Emphasis, and Cyient is down 8% right now. Amber is another one of those, right? Big moves yesterday. And I think ended 10% higher. It's up another 6%. So back above 7,000 bucks on Amber. And then maybe look at Ujjivan Small Finance and Spandana Spurti, where there is stress which has showed up. And so 4% on Ujjivan Small Finance and Spandana, which is down about 5% or so. Nigel?
I think one more, Sona, BLW, I'm not sure if you mentioned that, but the last quarter was weakish, and they're saying quarter 4 as well will not be that great, and they're saying that better times they're expecting in FY26. These are some of the stocks that traded elevated valuations. Longer term stories could be intact with regard to penetration, higher kit value, etc. But for the time being, the street is a little bit skittish because quarter 3 was weak. Quarter 4 as well is likely to be weakish as per the management commentary. We'll get the management in the next 20 minutes or so. So we'll understand from there. But for the time being, that stock is pulled back closer around 6% as we speak. And from the broader markets, Jyoti Structures, when we're talking about the economy slowing down and you don't have orders coming in, this one won a big order. So I think the street is happy about that, up closer around 9%.
All right. So that's 1 million shares, 9%, 24 bucks on Jyoti Structures. We got the first rate starting to come through in the market, and then we'll sort of dive down into all of these stocks in terms of how they start to trade at 9:15. So we closed on the Nifty above 23,200. Let's see how much we can build on that. The Bank Nifty ended slightly lower, about 0.25% down, so that underperformed. And of course, the broader markets, mid and small cap indices were up between 1% and 2% yesterday. So there is, of course, a fair bit which has happened over the last couple of days, and of course some recovery yesterday, and the last hour day before yesterday. So just counting down, and we'll have the first rates up shortly on your screens coming through. What do we have? I think it's going to be mainly a wait and watch kind of a start, and it'll be more activity as far as in this specific stocks go. So yeah, I mean, slightly ticking into the green on the Nifty, 23,218. Nifty Bank is nothing, I mean, almost unchanged, but slightly in the red. The sensex is unchanged. It's okay, Nifty Bank is down 0.17 now, but these are very, very flat and sort of nothing kind of rates. IT index, one of the bigger ones, absolutely flat. IT, the index was up 2% yesterday on the back of all those earnings and very strong mid-cap reactions. 20 points now on the Nifty, more up than down, as you can see on the Nifty heat map as well. Surbhi.
Yeah, I was just looking at the accident of the morning. Has to be Cyient. CEO is exiting. They've cut the guidance. They're saying growth could actually fall by 2.7% in FY25. Market just doesn't like that, given how strong a lot of the other mid-cap IT companies have been. So Cyient is dealing with a problem right now. Anyway, on the large cap screen, what's working well is BPCL. By the way, HPCL's numbers have been well received and seems to be rubbing off on BPCL as well. That's a stock which is in the Nifty winner right now, 2% higher. Other names include Coal India, JSW Steel, there's Shriram Finance, which is up about 1%. Some buying on Eicher Motors. A few large names like SBI, Reliance, ICICI Bank on the upside of the screen for now, but nothing to write home about. Even Axis Bank is up. But let's see, it is looking a little tricky at the start. Dr. Reddy's is straight away down 5%. Disappointment there. 9% down quarter on quarter on US sales. The market doesn't like that. Then there is Apollo Hospitals, some profit taking on Maruti Suzuki, Trent, Cipla, Sun Pharma. Actually, all of Pharma seems to be down to begin with. Nifty up about 46, 47 points. And that's on the hope that some of the larger banks will stay afloat.
Well, that's right. Surbhi, let's bring some good news first. Here, KFin Tech, the EBITDA numbers up by 30%. Revenue has jumped up by 30%. Stock has seen a sharp correction from the recent peak. It wants to bounce back. It's bouncing back. Thyrocare. Stock went to around 1,000 rupees, pulled back big time. The numbers look pretty good, and they are on their way with regard to the recovery. So the EBITDA is up close to around 30% or thereabouts. The margins have expanded now to around 25%. If you pull up a chart last few quarters, that margin improvement is something the street likes. So that one as well is bursting away. Jyoti Structures, it seems that one is up. I think it's locked closer around 10% as we speak with regard to that order win, 740 crore order win from Power Grid. So the street likes that. The door is shut on the other end with regard to Cyient. It's down 10% and pending sell orders out there. So the performance wasn't great. Resignation at the top. Street very, very nervous on that one. Tejas Networks, that's down closer around 8%. Remember, some of these stocks saw a one-way move. And now, in fact, with numbers not coming about, the street doesn't like it too much. EBITDA down 30%, margins contracting to around 14%. So that's one of the big casualties early this morning. And Go Digit, that did well, in fact, yesterday. That stock, in fact, is pulled back close to around 3.5%. And by the way, as we were doing that check, United Spirits a little bit tipsy today. The start was in the green, but that stock has pulled back right now. And if I saw it correctly yesterday, towards the end of the trade, there was some pre-buying. Yeah. So that's why the pre-positioning actually is hurting the stock. As Manglam said, no worries on that front. But it's a good start. We're 400 points away from that crucial level of 23,650. The bulls would like to end higher than that in the next 5 sessions to avoid the fourth straight month that we end in the red.
All right, 23,275, so 70 points higher. Slow and steady ticking up, essentially, is what we have going on at this point in time. So, this is decent. Can live with absolutely with these kind of prices. Hopefully, it stays and maybe builds from here out. So, there's a fair bit to track. So, I'll come back to individual stocks, etc., in a bit. But let's welcome in Karthik Kumar, fund manager at Axis Mutual Fund, who's with us as well. Karthik, good morning. Great to have you with us here on the program. Thank you for your time. So, what's the broad makeup at the Kotak team? I mean, is it one of risk aversion? Is it one of hunting for opportunities and looking at what to buy, whether it makes sense, that makes sense, or I mean, just the mental makeup right now?
So effectively, what we are seeing right now in terms of style, if I were to break it down in the markets, is that lower risk, and value in general is holding up well. And even within value, if you were to kind of dissect it down, it's low value is not getting, like cheaper stocks are not necessarily getting rewarded, but costlier stocks are getting penalized in the markets. And the other way to look at it is, as you mentioned briefly before as well, which is higher growth stocks. And so growth stocks and momentum stocks are taking the hit as well during the course of the correction over the last couple of weeks. So that's what we are seeing from a style perspective in the markets.
Karthik, right now, are you fully deployed, or is there some cash on the side? And what's the broader strategy that you're adopting, given that we're in really choppy waters, too much news flow, there's a budget coming up, and a fair amount of price damage has already happened in large parts of the market?
That's much more specific to schemes and the kind of strategies we are running. So I think that would have to be taken up at a scheme level or at a strategy level. But in my case, I'm still running the portfolio largely deployed. Obviously there are changes in positioning, and we kind of constantly evaluate to see which place is the best to stay in, given the nature of these markets. But as far as I'm concerned, I'm largely deployed.
Which is what I'm asking. The broader strategy framework right now, in terms of the models that you're following, what exactly are you doing in a market like this, and what's the advice?
So in terms of where we are seeing earnings upgrades is still, we are seeing earnings upgrades in pharma. We are seeing earnings upgrades in some of the selective discretionary space. And we are still seeing earnings upgrades in some of the select industrials names as well. So in terms of our overweights, we are much more aligned towards that. Whereas a large part of the earnings downgrades is where we are seeing in selective consumer staple names, and the metals and commodity names in general continue to see pressure as well. So that's how I'm positioned from a sector perspective, where I'm overweight healthcare and selective consumer discretionary plays, whereas I'm underweight energy, commodities in general, and staples as well.
All right. Hi, Karthik. Good morning and good to see you. And Karthik, what about consumption? I recall we chatted about this in the past, and I think you were hinting that maybe it's time to start nibbling in. How are you all placed on the consumption theme, and what do you like out there, staples or discretionary?
Still prefer discretionary over staples. That's been the case for some time now, and I'd still stick to that. Discretionary, within discretionary, extremely selective as well. At least in my case, we have exposure to two-wheeler, some of the two-wheeler names, some auto ancillaries, selective consumer retail exposure plays, discretionary retail exposure plays. That's where our exposure is. And on the staple sides, it's extremely selective. Less of the benchmark heavyweight names, and some of the less heavyweight names from a sector perspective. So it's more bottom up from a staples perspective, but in general, still prefer discretionary over staples.
Something you said right at the top, Karthik, do you think the market style has changed and it will stay changed through 2025, that high PE doesn't get rewarded? So no point chasing the previous winners. And so in that sense, it's an important point. Do you think that has already happened and it'll stay that way now for the foreseeable future? What's the sense?
I think it's too short. I mean, we've seen this over the last 10 days, and I think it's too short a time period to kind of conclude one way or the other. Because what we are seeing is in stocks that are reasonable, that have higher valuation but have delivered numbers, those stocks have bounced back strongly as well. So I think things will recalibrate post earnings, and where there is chance of earnings downgrades, to take a step back, if the earnings expectations is high and there is a remote chance of earnings downgrades, and those stocks and those sectors I think are more likely to be under pressure is my guess. But we still have to see at the end of the earnings season to see how it pans out. While this is in general, high growth and high momentum stocks have been kind of laggards or have been hurt over the last 10-15 days. But I think the market should start differentiating even within that group to kind of treat better some of those names that continue to deliver on their numbers.
Okay, got that. Karthik, final sense, we've spoken about what you like and where you're deploying. Where would you be taking profits from? I mean, for instance, in the EMS space, we saw that this week because valuations are so elevated. The slightest hint of a miss or, the slightest commentary going off track, and there was a big correction that crept in, but then there's buying also. So like that, which are the pockets where you think it's kind of done for now and it's time to take some money off the table?
Some of the areas where we've kind of reduced our exposure to over the last couple of months, to look at your question the other way, is some of the industrial names, some of the cap good names, and utility plays as well, where I've taken some weight of these sectors.
Okay, all right, Karthik, I wanted to ask you about cement. We have gone through this phase. I'm looking at the leading indicators, whether I'm looking at cement, steel, credit card consumption, everything for January actually has not grown big time on a year-on-year basis at least. And now we're hopeful that we'll see some kind of action coming in the budget or from the government itself, as well as RBI could loosen things a little bit. If that's the case, the economy will revive. And some of these cement companies have not done much. What do you like from there? We had the leader yesterday, Ultratech Cement, extremely good set of numbers. How are you all placed on cement?
Personally, I still continue to remain underweight the entire commodity space. While you're right that if the government were to be proactive, both from a fiscal perspective as well as from a monetary perspective, RBI, then we might see a fillip there. But there can be other areas that we can evaluate in that scenario as well. And as of now, in general, the earnings environment, notwithstanding what you mentioned with respect to one particular company, still remains largely tepid in that space. So we'll still like to play all the themes that you mentioned through other sectors as it stands today. But if things do materially change and we start to see a pickup in underlying numbers, then happy to change my stance.
Okay. All right, Karthik, we'll leave it on that note. Thank you very much for joining in, and you have a good day today. Well, with that, thank you very much. With that, let's move on and get you more interesting voices from the World Economic Forum in Davos. Shireen caught up with Rishad Premji, Executive Chairman of Wipro, as he talks about Trump 2.0, AI upskilling, and also sounds optimistic on the business itself, saying 2025 will be a much better year than 24.
Joining me now is Rishad Premji. Rishad, always a pleasure. Many thanks for joining us here in Davos once again. It's, as I said, this has been a Davos that's been largely dominated by 2 or 3 themes. Number one, of course, Donald Trump and what the US presidency is going to mean for the world. 2, a continuation of what we saw last year, which is AI. But the needle now seems to be moving towards it's real. What more can we do with it? How quickly can we move forward with it? And 3, India. Where do we find ourselves in the mix of the global uncertainty, and how much more can we draw in from the world? On each of those, let's unpack that, and let's start with Trump and what it eventually means as far as business confidence goes, spends for your sector, for instance.
Yeah. It's good to be back, Shireen. It's good to see you. This is our annual get-together, though I saw you in the middle of last year,
yes,
which was a treat. Look, I'm quite excited about what comes out of the US. I think, people like certainty and clarity. I think that's over after the elections. The new administration, I think, certainly talks about being very pro-business, pro-industry, pro-growth, which I think will unfold in terms of how regulation unfolds, how taxation unfolds. And so I'm excited about what that presents for our industry. And one is already seeing initial signs of organizations, companies coming out of the US thinking about that more purposefully. We'll also have to wait and watch what it means for tariffs and what it means for immigration, and so what it just generally means for inflation and how that creates some sort of a complexity in the unfolding of the pro-growth, pro-business agenda. But I'm generally quite bullish about the outcome of the elections from an industry standpoint.
Yeah, and I think that's what we're picking up in the conversations, the many conversations that we've had here. But if I were to, that's the macro, but if I were to link that to the micro, and BFSI, for instance, I mean, everyone's now talking about the possibility of deregulation. What will that potentially mean, right. In terms of their abilities to spend more? What are they going to spend it on? What are you hearing from the clients that you work with?
No, certainly, I've met a lot of our banking customers here, and they're certainly looking out for the deregulation. How that actually transacts will have huge implication. How much that actually translates into actual spend reduction on compliance, I don't think it's going to be as linear as the regulation reduction. But I think organizations, especially FS companies, are quite excited about just having less complexity and being able to get on with the business. So again, FS is an industry that's seen activity pick up towards the last half towards the half of last year, and I expect that to continue as we get into 2025.
So 25 likely to be a better year than 24, significantly better, a little bit better? I mean, what's your read?
I mean, it's just starting.
Yeah.
We've been a few weeks into it. I'm hopeful that, we should see a better year than 24. I'm hopeful that discretionary spend should pick up gradually, but pick up as we move into 25. And I get great comfort in our specific case from our consulting business, right, which is highly discretionary, and they've had a good 24, and that momentum seems to be staying and sticking. So I'm looking forward to 25.
Well, speaking of 25, as I pointed out, the second big trend here is the AI conversation continues. It's now moved into from generative AI now to agentic AI, and the promise that holds. I mean, your chalet here is also all about AI and talking about how AI can save you time and improve your life and the future and so on and so forth. You're obviously also betting big as far as this space is concerned, but how do you differentiate yourself? I mean, you walk down this street and everyone's got something to do with AI. How do you create a differentiator?
Shireen, we're focusing on three things, right? One, we're focusing on how do we operate better as a company. So how do we make AI all pervasive within Wipro? And we're calling it AI-powered Wipro. We're spending a lot of time skilling our people. So we've had 235,000 people go through a Gen AI 101 skilling, including me. We have about 50,000 people on higher levels of AI training, and they've gone through actual certifications, about 5,000 people at level 3 and about 500 people at level 4. And we're using that to drive a very strong mantra of think disruptively with AI first. And so we're changing all our functions, whether it be HR, finance, legal, sales, recruitment, skilling. And I'll give you a simple example, which I love, and I use this personally. We've introduced a simple bot into our HR organization to do everything for you, help you do everything from find your appraisal, apply for leave, figure out whether root canals are covered as a part of your dental policy, what your travel policy is, etc. They are in some cases. And so we've had 10 million queries in the last 12 months with 98% accuracy. Now we have a large shared services that supports this. That number will come down dramatically, but we're creating delightful experiences for employees who don't have to maneuver the complexity of the intranet to figure something like this out. So how do we operate better is becoming a very strong mantra within the company. The second thing is how do we deliver better? So the projects that we're already doing for customers, especially in the fixed price projects, how do we leverage AI to disruptively change the way we deliver? How do we infuse AI to drive differentiation there? And the third is how do we change the game for our customers, which means how do we bring very domain-specific, context-specific solutions for our customers. So for example, we've built something for FS customers called Wealth.ai. It's a dramatically strong enabler with human in the loop to help financial advisors be much better at understanding their customers, knowing their customers, having a full view of their customers, cross-selling, upselling. And you're seeing the benefits of that flow through with real customers. So this is not academic and sort of in POC mode. It's actually in production.
All right, let's get straight to our next management. We have Sona BLW Precision. As we highlighted earlier, the stock was down close to 6%. But take a look at what's happened on the screen. That dip has got bought into, and the street believes that maybe, in the longer term, the prospects could look up. Let's find out. We're joined by Vivek Vikram Singh, the Managing Director of the Group CEO at Sona BLW. Hi, Vivek. Good morning and good to see you in. Well, as I said, Q3 was a little bit soft. Q4, I believe there are still some kind of headwinds that are likely, to play out, and it could be a tough quarter. That's because of the model launch related transition for your key US customer. I think you mentioned that. So you're saying that growth will normalize in FY26. Could you tell us what kind of a growth should we expect on the base of FY25 and FY26?
Good morning, Nigel. That's a lot of questions rolled into one opening question.
No, I just want to know what is the growth rate, Vivek, in FY26 in comparison to FY25? Give me a number, give me a range, I'll take that.
Yeah, but we don't give future guidance, but it'll be good. It's a fairly solid year, FY26. And even if you look at 9 months or YTD for this year, revenue is up 17% and net profit is up 19%. So, weak, yeah, but probably compared to our past performance, not really that weak. Even on a quarter basis, I think revenues up 12% and net profits up 14%. I would, beginning of any quarter, if someone told me that you'll end up with double-digit growth, I would take it. FY26, of course, is considerably better. There is some bit of revenue that's actually shifting out in a way from Q4 to Q1 and Q2 next year because of the model transition that you rightly pointed out. So yes, as is our policy, we try to put bad news first. So whenever we have positive news, we probably take it slowly and conservatively, but negative news, we try to get ahead. I think that's what the stock has been reacting to, because for the first time ever, I think we called out that next quarter we expect to be weak, which is rare because, we've had 12 straight quarters of sequential growth.
Got it.
So it was unexpected, and I think we owe it to our shareholders to be fully transparent. And I know in a low trust society like India, honesty doesn't always pay in the short term, but we believe in the medium to long term, it will pay out.
The street is at least better prepared, Vivek. They know that quarter 4 is going to be soft, but as you're sounding quite optimistic about FY26. Let's focus on a couple of other numbers then. In terms of margins, because of the product mix, because of some softness in demand, margins were a little bit tepid. But going ahead, what is the trajectory on margins? If you could give us a number, what should we be working with in the coming quarters? And also, since we're just talking about revenues and the outlook looks pretty positive, on the base of FY24, I believe that by FY27, the revenue should double. You stick by that? That means you'll do around 6,200 crores of revenues?
Yeah, so every 3 years, I've been in this company for 10 years, we have managed to double or more. I think if we look at FY27 upon 24, we hope to be able to do that again. So that looks in line. On margins, we've been in the range of 25% to 27% for the last decade. We don't expect that to change. Mix can vary and swing from quarter to quarter, but if you look at a 3-year period, that's where it should stay. There is one thing, though, that I must add. That we acquired the railway business of Escorts Kubota. Now, whenever that comes in, that has a lower EBITDA margin. It has a net profit margin is pretty similar to what we have in our core business, but EBITDA margin is lower. So that may change this, but once we consolidate, we will know more about that. Hopefully, we have said September next year or September 2025, but hopefully we can close it earlier than that and try to start consolidating that bit too.
Vivek, good morning. Thanks very much for joining us, and it's nice to see a radiant, smiling face. Good to see that. So just a couple of questions here. So there's, I think from the last time we spoke, we've got a new president in the US. I think we spoke about tariffs, etc. at that point briefly, right? Now, of course, we know that the man is there. 40% of your revenues comes from the North American market. How much do you, what you sell in the US, you make in the US, Vivek?
We do make some parts of it in the US. We also make some part of it in Mexico. 43% is our revenue from US as a geography or a market. But if you look at what we do for American customers, that number would go to as high as 60%, or American origin OEMs. So contrary to what a lot of people believe, I think President Trump's administration will be really good for a company like us. Because if he indeed follows through on his promise of doing good for America and for American companies, that should be fairly positive. And I'll tell you the reason. Tariffs, we get confused in auto and auto components, I guess. The difference in tariffs between what US levies on Indian imports versus what we do for US imports is not very high. Depending on categories, between 5 to 10%. So even if reciprocity were to come in, given the current USD INR 5% drop, it is negligible impact expected. Second, The biggest import, $83 billion odd is what...
Sorry, Vivek, this is, it's for components it's negligible, you're saying? Because OEMs, I'm assuming it's very large, the disparity.
OEMs is a different story altogether.
Okay.
Yeah. So
but we are dealing with components, and since it's your business, so you're saying that's great to hear. Sorry, go on. I interrupted you.
Yeah. So if the auto import duties all over the world are to literally be equalized, which would mean US cars will start doing well in other markets and they can actually start exporting US cars. That would be actually fairly, not fairly, very, very good for us. Okay. So we see this as a net positive actually. And when you look at the import, like I said, $83 billion, Canada, Mexico, China are the big three from where the US imports its auto components. If they too have tariffs, frankly, India would be in the best bargaining position in this place.
Okay. All right. Yeah. Vivek, just assuming that 5-10% is levied, is it viable though, for a US OEM? Because I think their cost of production will go up much higher, right? So it may not be very viable, if you could clarify on that point. And also in terms of a Mexican plant, it supplies in Mexico only, right? So there won't be any negative impact if Trump puts some tariffs on Mexican imports. Is that correct?
So Nigel, absolutely right. I was just trying to answer that hypothetical that what if reciprocating traffic were to be put? I don't think they would, because this does nothing except raise the prices of US cars. So it's self-defeating in a way. I doubt they will touch auto components. It's a $1.5 trillion industry. There is a lot of outsourcing. It will make it more expensive only for US customers. So that would defeat the purpose. The Mexico plant, that was a good question. We do, or the initial intent we are launching next year from this plant, is Mexico to Mexico. That should be unaffected by this. But again, I think what we are missing, and Prashant, the thing we talked about was the EV policy. If they do away with the EV subsidies, that would be the single biggest benefit that a company like ours would get. Because that would mean that the American car market splits into two. One, the legacy players will focus only on ICE products, in which we have a fairly high share of ICE supplies. And the EV-only players will do only EV. The losers will actually be non-US car makers who make hybrid, because as you know, the subsidy, $7,500, also goes to plug-in hybrid and hybrid vehicles. The moment that goes away, hybrid sales should plummet and EV sales and ICE sales will increase, which is pretty much the best case scenario for us as far as the US market is concerned.
That's very interesting. And this calls for a deeper discussion, which we will do maybe outside of this sort of occasion when we talk about results, etc. Just one quick thing, Vivek. In terms of dependence on China for components and parts, etc., are you dependent at all?
Negligible. There is some permanent magnet import, some bits of semiconductor stuff, but that can be rerouted via Taiwan. We are actually net exporters to China. So we don't have that issue. I think we should look seriously at China as a market and as an opportunity. And frankly, that's what I would be focusing on in the next decade of my tenure. How to grow, not just in the West, but try to grow in the East also.
Absolutely. There's a big, huge market, bigger actually than the US.
Biggest market in the world.
Biggest market in the world. Vivek, thank you very much. Shorter conversation, but we promise to sort of invite you again and we can sort of go into some of the details of what's happening with tariffs and trade, etc., and how the market composition itself expands, changes. But appreciate your time here this morning. Well, time for another exclusive chat from the sidelines of the World Economic Forum in Davos. Sanjeev Bajaj, CMD of Bajaj FinServ, in conversation with my colleague Shireen, saying that liquidity line to NBFCs from the RBI will be a great confidence booster for the market. He also spoke about how the arrival of President Trump in the US may cause some uncertainty. Listen in.
Joining us now on the program is Sanjeev Bajaj. Sanjeev, many thanks for joining us here in Davos. You've been here for many, many, many years, but this is really in many ways a Trump Davos. What do you sense from what you hear?
So very clearly three issues that are relevant to us. One, the US economy surprisingly continues to be very strong. And that's one thing to take note of. Second, Europe continues to be in the doldrums, and they realize now that they've over-regulated themselves. That has led to slowdown. They have to cut regulations so that they can get competitive again. Third is, there is going to be a period of uncertainty with the arrival of President Trump. So you have to wait, you have to watch, you have to nimbly manage and be agile. I think the first 7 days, the first month, the first 6 months will be important. By then things should settle down to the extent that you at least know what's the unexpected to expect. And one has to plan on that basis.
The mood on India. We have, of course, seen things slow down a little bit. The hope is that as CapEx starts to pick back up, we will start to see an improvement in the second half. What are you seeing at this point in time?
Yeah, so firstly with CapEx picking up, especially from the government side, which is really what has helped us through the last few years as well, that should play a positive role after the monsoons. We are seeing some pick up on the rural side. Urban consumer demand is still a little slow. I'm hoping in the budget we see something to spur that as well.
What are you hoping for?
You know, very clearly when there is some slowdown on the ground, you have to find a way to get beyond that. So I hope whether it's some tax breaks for the middle class or at least the lower middle class, some amount of reduction on excise duty on fuel will help prop it up. And once then it comes up to the right level, you can always readjust. So that nimbleness is required. So hopefully we'll see a little bit about that. Beyond that, the world is still very positive and very hopeful on India. They see us as a strong, stable partner. They've seen the positive work that has happened in India over the last decade and more. They know that, okay, maybe we are not as fast as some of these smaller economies which are very centrally driven. That's the positive, but then it has its own negative as well. But they do want to see us more competitive, more open to the world, not do anything retrospective, so that there is certainty. The more we can provide them confidence there, I think the greater the opportunity to bring more and more businesses into India to produce whether products, services, and export them, and for them also to get into the domestic market.
So are you starting to see now improvement as far as offtake is concerned?
So we are starting to see very clearly on the rural side. Urban, as I said, is still a little soft. We need to see improvement there.
And the concerns on what happened on the unsecured front, of course, the regulator put the speed breakers in place. Are things starting to stabilize there?
Very much so. So the regulator caught the delinquencies rising very early on. This was really small value unsecured loans. Tightened that. The delinquencies have started coming down. They are not down to their lowest levels, but they've started coming down. And but again, you have to be agile. So you have to know when to open up as well. Because within that consuming borrower, there is a segment that needs the money. If you're not going to give it to them as the formal financial system, they unfortunately have to go to the informal system, and that's worse. This continuous balance is required.
Well, speaking of additional measures, and of course, the hope is that there will be a rate cut by the MPC in February. Also, perhaps the need for more liquidity injection. We were at the CII budget town hall yesterday, and that is what was the ask, CRR plus repo. Is that the expectation that you're going in with as well?
Yes, liquidity is very low at this point, as you know, negative 2.5 lakh or so. We need to pump in greater liquidity. Second, liquidity is not really a challenge for the big banks. But you have to keep in mind that a large part of our system and our credit that goes into tier 2, tier 3, certain segment of society and below is NBFCs. And these are large NBFCs. Some of us are bigger than most banks. You need to make sure that similar kind of liquidity lines are created for us. See, NBFCs were not really in RBI's radar till 10-15 years ago. They are now. What they correctly did was created the layered level of NBFCs, brought in more supervision, brought in more inspection to make them more robust, completely understandable. But now give them those additional tools also to go and do their jobs.
What additional tools would you require at this point in time? What do you think is the need of the hour?
I think the single main thing is a liquidity line to NBFCs from the RBI. This creates confidence in the market. We know there are periods of tight liquidity. We can tap into that. It doesn't have to be a cheap line, but the availability of that makes a big difference.
All right. So the need of the hour is to create a liquidity line for NBFCs. That is a word coming in from Mr. Sanjeev Bajaj. And of course, I will keep getting you more from Davos as we go forward. Let's take a break right now. Coming up on the other side, get back to earnings. Memphis will be joining in to talk about the third quarter performance and the outlook beyond. Welcome back. So the shape of the market now is down. We have not chosen to go along with Asia. There's no green here. It's a big sea of red, actually. Nifty's down about 25 points, but the cut is a little deeper in the mid-cap index. The mid-cap index is down almost 1%, and it's the bank Nifty that's leading the losses, down about 0.5%. But sticking with earnings, let's move on to the next company. Memphis is on our radar. The stock has been reacting to the earnings fine print that came out. Revenue growth was a little below estimates, but deal wins have been pretty strong, as has been the commentary, and margins have been fairly steady. So to talk about the performance in the third quarter and the outlook, we have with us Nitin Rakesh, CEO, and Arvind Viswanathan, CFO at the company. Gentlemen, thank you very much for joining in. Good to have both of you on. I'm just going to start with the fact that the constant currency growth, Nitin, is just about 0.2%, and the market would have, of course, loved to see more. However, you are talking about record deal wins. So how does it tie up? Was it just sort of some seasonality that hit in the third quarter? And what's the outlook as we look ahead?
Sure. I think the deal wins are at about a 6-quarter high. Pipeline is probably at a record high, up 50% year over year. So I think what that tells you is that the pace of activity is definitely picked up in the environment and in the business, led by banking and TMT. So something we had called out over the last 3 or 4 quarters as well. I think there's some work to do across some of the other verticals and geographies. US is definitely doing okay. We have some work to do in Europe, especially as we think, see recovery in BFSI back in Europe through 25. Pipeline, as I mentioned, is pretty strong. So are the deal wins. So good news is the order book continues to strengthen. Sequential growth obviously was a little bit impacted by the fact that this was a seasonally weak quarter, and we do expect to recover growth back in Q4 as we round out the year.
Okay, so it was just seasonality in the third quarter. Got it. Now, you've been maintaining that Memphis will perhaps post better than industry growth. But help us with some sense of what that really means if we're talking FY25, because it's very, very different across different companies. There are companies that are managing to grow at 25-30%. There are large companies that are barely doing 3-4%. So, what should we understand by industry-leading growth?
Yeah, I think each company has a different, portfolio and a dynamic. Of course, for us, we are in a phase of recovering growth after a fairly tough, environment in calendar 22 and 23, driven primarily by, the deep cuts that you saw in, discretionary spend coming out of the interest rate cycle, partly linked to the portfolio that we've run. So good news is we've seen the recovery of that over the last 4 quarters. And as we define industry growth, it's really the weighted average growth of our peer group across all gap segments. Given where we are, given the remainder of the year, really Q4, that really means you're looking to grow, above the single, midpoint of the average growth. So basically,
and what's the weighted average, Nitin? Or what is that weighted average across your peer group?
At this point, the weighted average across the peer group is, south of 5%. So I think if you think of that as kind of the baseline, for us, the effort has been to grow above that number. And I think this has been a decent, recovery in terms of the YY growth number. And as we pick up pace in sequential growth, you will see that pick up as well.
So you'll grow above means what? 1.2 times, 1.3 times? What should it be?
I think at this point, above is where we will be. We've stayed with that through the last year since we started FY25, and we'll leave it at that.
All right, let's focus on margins then. You're currently in the middle of that guided band, but since your deal wins are good, you're going to grow better than the industry as well, and you have operating leverage that will play out. Do you think margins will gradually move towards the upper end of the band?
Arvind?
Quick update on the current quarter, right? So we did 15.3%, which is a marginal drop in a seasonally weak quarter. So we've been operating reasonably at the mid-range of our guidance, right? So that the reason there is a range is that we could operate at the both ends. And I think as growth picks up and, some of our investments pay out, I think, there is headroom for margin to tilt up. But we'll wait and see to see how it kind of unfolds.
All right. Okay, all right.
So just to, press you a bit on that margin front, I mean, the band is, I think, 150 bips, right? If I'm not mistaken. So as you're looking at a pickup in discretionary spends, which is what Nitin highlighted, what is happening on pricing? I mean, I don't know if maybe it's too early a question to ask, but when you talk pricing with clients, what's the feedback you get? Is there any elbow room to increase Maybe, in some geographies across some contracts, or none at all?
I think at this moment, yes, pricing is a reflection of competitive environment, underlying demand, but it's also a reflection of what segment of the market are you playing in. If you think about, the forward-leaning approach that we've taken on a lot of the tech platforms, I don't think the primary issue that we have to deal with right now is the pricing, competitiveness. Yes, we have to be competitive, but I think clients are willing to pay for value. I think the primary rub right now is how quickly can you tap into the opportunities that are being, presented by either the current AI, adoption, or more importantly, areas where, we do have an opportunity to become more competitive using AI. So I think pricing for us we're in a comfortable position. We've seen fairly, forward-leaning approach from customers as well when they see value. Focus right now is prioritizing growth. And I think we will continue to hold margins in that stable band. As we get into FY26, we'll give you further guidance on margin as well. But I think at this point in time, 100% focus really is on driving growth.
All right, the AI-led pipeline for you has moved up from around 35% to around 55%. So that's telling us a thing or two about your focus area. Another query that we normally wake up to in the morning, not very company specific, is what's the Fed going to do? And now there is a moderation in terms of expectations, because at the start of this year, you would have thought that maybe we'll get more hikes than what we're currently working with. But what if there is moderation in the Fed's rate cuts? How does it impact your business?
I think, again, it's, predicting the bottom of any cycle, especially interest rates with such complexity in the macro, is very hard to do. So what we've tried to stay away from is build a plan or an outlook or a guidance based on where we think the macro will be. The focus has really been more on the micro front. What can we do with our existing clients in our existing geographies and verticals? And how do we really take opportunities that are being presented? And that's the way we've operated the business for the last few quarters since macro became uncertain. It's very hard to predict whether there'll be one more, cut, two more cuts, four more cuts. I think anybody who has a good sense is really, not 100% confident either. So for us, we've seen, some impact of the turnaround in interest rate cuts over the last 3 quarters in the business, specifically in the mortgage segment. It stabilized a lot before that. If there is any additional activity that helps our business, I think that's the upside risk to where we stand today.
All right, just one quick question on your verticals. BFS revenue, that was up by around 8.5% on a year-on-year basis. And insurance as well did pretty well at around, I think, 7% growth. Do you see that growth number gradually moving to the double-digit mark?
I think that is the effort that we've been putting in. We called for a recovery in BFS as well as TMT about 4 quarters ago. I think we're inching close to the double-digit mark in BFS. If you look at our direct BFS growth in Q3, it's almost 10%. So we are fairly confident that recovery will continue to pick up pace purely based on the deal activity and the closures we've seen as well. So I think good place to be. And as I mentioned, right, if macro turns more favorable, there is upside risk to that number growth from a growth standpoint as well.
Finally, Nitin, can't let you go without asking about AI and what that's meaning for your business. I think from what our colleague Rima was telling us, the pipeline is at about 35%. In Q2, it was 35%. Now it's at 55%. Can you tell us how that's contributing overall to the revenue and what's the trajectory?
I think the phrase we've used is AI-led. What that means is that a number of opportunities get opened up because you have the ability to use either an AI platform, third party or our own, to actually bend the cost or the efficiency curve, and in some cases create an ROI that probably wouldn't have existed without it. So it's a fairly good place to be. I think the last 2 years since OpenAI launched ChatGPT, there was obviously a fairly high degree of interest at the enterprise level from an adoption standpoint. We are starting to see the pace of adoption really pick up. And I think 25 will definitely be a good year from that perspective. What we are doing is bundling that into a number of our solutions. And that's leading to growth in pipeline. That's supersizing deals as well, actually. And ability to then drive closure is also getting fairly clear. So that's one of the reasons why you've seen a pickup in TCV numbers for Q4. For Q3, we've also announced an additional 100 million plus large deal in Q4 already. So I think that's a sign of things that hopefully point to a resurgence in deal making through the remainder of 2025.
Okay, all right, gentlemen. Appreciate you all stopping by, giving us details with regard to how you see business shaping up and also sounding reasonably optimistic about growth for FY26. Look forward to having a chat with you all in the next quarter as well. As we were having that chat, guys, just take a look at the Nifty. It's down close to around 65 points and a few stocks that have slipped. SBI Life, that's moved to the low point of the day. You have Trent as well that's coming for some selling pressure. And the normal suspects, from the broader markets as well. You have stocks like Kalyan Jewellers. Well, that's moved down yet again. It's down another 2%. I saw that, Suzlon had a bit of an uptick in initial trade, but that's got sold into as well. So that comes up for you on the screen. So a little bit of nervousness is what we're seeing in the broader markets. Even Z Entertainment, it started off in the green. That's sold off. And Zensar, that did well yesterday, that as well has moved to the low point of the day. The pressure is in the broader markets. The headline index is down only around 60-70 points. But the pressure on the broader markets is something that's telling you the kind of nervousness that we're seeing. But yet again, as I say, a lot of these stocks have come to pretty decent valuations from the broader markets. You need to pick and choose the ones that you want to get into. Let's find out how do you trade the technicals though. Mitesh Thakkar joins us on the show. Hi Mitesh, what do you make of today's initial trade? Do you think that the trend is still on the upside? Would you look to buy this dip, or do you think the markets are seeking lower levels? So you believe that in fact you'd rather not buy the index, and also fill us in with your trading picks.
Yeah. So I think the market hasn't yet given any big sign of a reversal. So I'm not buying the index on this dip. I'm not sure, whether we are looking up or down. We are in the middle of the range of 23,000 to about 23,350. Practically going nowhere. So just wait it out. On the stock side, I think, there is some kind of a negative movement which has happened on the chart of Syngene. That's a breakdown over here. On a mild pullback, say around 780, 790, sell with a stop at about 811 for targets of 750 to begin with. We might actually see much lower levels than that as well. So that possibility is open. And Ultratech Cement is a buy. Keep a stop at 11,150. Look for targets of 11,850.
Got it. We'll keep an eye out on that. Thanks a lot for that, Mitesh. For the time being, we'll slip into a short break. On the other side, we'll focus on some stocks that are on the move. Stay with us.
Welcome back. Let's take a look at a couple of stocks that are on the move. Rima is joining in to talk about the huge disappointment that's playing out on Cyient. Numbers not good, plus management change. Rima.
For Cyient, there are two key negatives, as we pointed out in the morning. One is the guidance cut. The company has lowered the guidance on revenue and margins. Now, for the full year, they're penciling in a growth of minus 2.7%. This is on account of right shifting of projects. And secondly, on margins, they were hopeful of exiting the year with 16% margin. Now, on account of aggressive wage hikes, the EBIT margin guidance for Q4 stands at 13.5%. So that's disappointed the street. And secondly, the CEO, Karthikeyan Natarajan, has stepped down in a span of 20 months. Versus his term of 36 months. So that came in as a negative surprise. That said, the management commentary was fairly upbeat. Now, brokerages are quick to respond to this. JP Morgan today has downgraded the stock to a neutral. But that said, there were a few positives in, the outlook from the conference call. One, the management said that this guidance of minus 2.7% for the full year, in a way, is the worst case scenario. It may not be as bad as that. So that's point number one. The guidance could be on the conservative side. Secondly, the company did see record deal wins in Q3. And also, the company is calling out a recovery from Q1 onwards following the strong deal wins. IFL, on the other hand, maintains a bullish call on Cyient on account of inexpensive valuations and a potential recovery. So they're saying the stock is trading at 21 times FY27 PE, relatively inexpensive, and therefore they have an add rating. But the risk is that the potential recovery does not take place. There are delayed ramp-ups which hurt the company.
Okay, all right, got that. Explains the 19% decline on the stock that we're seeing right now. Rima, thanks for it. Let's quickly move on and look at Mankind Pharma. Even here, the numbers have not exactly hit the mark. Vinny, share the details with us.
Absolutely. So in terms of Mankind Pharma, what we're seeing coming in, it's not a great show coming in. We're seeing a red that is expected as it was expected because Q3 numbers were just slightly in line with estimates. Let's not compare it on a year-on-year basis because there was a BSV integration that came in October 2024. So because of that, year-on-year basis, it's not something that we'll compare. Now, what didn't do well was the profits of the company saw a sharp decline because there was an increase in finance costs. Finance costs was at around 221 crores versus just 9 crores. And this is increase in terms of the debt that has come in because of the BSV integration that has taken place. Other than that, domestic sales were somewhere around decent growth when you look at it, but revenue margins, nothing exciting on that front, and margins also have remained quite flattish. So that is why Mankind Pharma was something that is seeing a fall in this stock.
Okay, all right, got that, Vinny. Thanks very much for that. Let's take a break on that note, come back on the other side, and we'll have our special segment Budget Countdown coming up. Lata will be in conversation with Kulin Lalbhai of Arvind and Siva Ramakrishnan Ganpati of Gokuldas Exports to discuss what the textile sector can expect from Budget 2025.